Taking a look at the interest rate markets today, I want to focus on the 10-year note, a big mover once again today. We're seeing some volatility persist now that some of the narratives and some of the data points in the marketplace are moving in a more positive direction. So we're seeing the 10-year note under some selling pressure again today. Trading in the 128 handle today, so 128.31 is about where the current price point is. Again, third day now of selling pressure when you look at the price action within the 10-year note. And I want to point out, really it's the narratives and the data points coming into the market now that are shifting the dynamics here, at least for the short term, when you look at the 10-year and you look at the interest rate structure as a whole. Looking at the data points today, the big mover today was the non-manufacturing ISM number. ISM number, non-manufacturing, so basically service-oriented, reversing course. Now, last month, that was the number that really caused the markets some anxiety and put that recessionary fear back into the market temporarily. So to see that number reverse this time around, particularly the U.S. being a very service-dominated economy, a positive note for the markets. Now, we didn't see the S&P rally so much because of some earnings situations, but we did see the small caps rally off of that news, and we also saw the Dow up as well. So we did see some equity strength on the heels of this selling pressure within the bond market. And looking at the other factors I think that need to be pointed out is the Fed continues to initiate a narrative here that, their Fed officials coming out basically saying that they don't really see much of a risk of recession at this point. And again, putting the mindset back in the market that the Fed's going to be on hold. So we're seeing that really play out within the pricing structure within the markets. And when you look at the 10-year, you're seeing yields now bouncing back up to the 1.86 level. So we're seeing them back up to those levels that we saw in September, where we saw a high of 1.9, I believe. So we're just below there right now. So we are seeing rates adjusting significantly. And if you look at the action today, along the curve, you're really seeing the selling pressure on the back end of the curve today more pronounced than it is on the short end of the curve. You're looking at the 7s, the 10s, and then the 30s really initiating the significant amount of that selling pressure. So again, we're seeing repricing here now as the market moves towards 2020. The expectations, at least to this point, are now being pushed forward that the Fed will probably be on hold a little longer than maybe what the market anticipated, even after the Fed said that they were going to hold off here for a few months. Now you're seeing it being pushed out further into the time frame, at least at this point, with some of the dynamics within the marketplace trending in the right direction. Certainly when you look at the ISM non-manufacturing number today, and the trade situation continues to progress in a positive tone. So those factors, I think, are pushing yields higher and prices lower, particularly when you look at the 10-year note.